Hi, so in this video, we are going to cover uh, some more topics on finance. Okay, so uh, there was already one video in my channel regarding finance, and this is the second video. And before I start the video, I want to clarify that I do not own this PDF, and this PDF was provided to me by my coaching institute, the Catway. Okay, I am merely using it for recording this video, and my videos don't have much of a reach. Okay, as if you check my YouTube channel, you will see hardly any video crossing 10 views, right? And most of the views, if a video has 10 views, then almost 6 to 7 of them is my own, right? Because I make videos for my own revision purpose, because it is easier to uh, study or revise the particular concept from my own videos, which I have where I have explained the concept in my own voice rather than visiting through some PDF or notes, right? So, without any further ado, let's get started. So, finance, right? We are going to learn finance. So, first pointer is finance is defined as the management of money and includes activities such as investing, borrowing, lending, budgeting, saving, and forecasting. There are three main types of finance: personal finance, corporate finance, and public or government finance. So it says that finance definition is it is defined as the management of money. Okay, in one word. And finance includes activities such as investing, where investors or company invest in various sources to generate some returns. Borrowing. So borrowing means basically where companies or any entity borrow money to finance their capital. Lending means giving on credit. Budgeting, saving, forecasting. So all these components are included in finance. There are three types of finance: personal, corporate, and public finance. Okay. Personal finance means your own day-to-day managing your own day-to-day personal expenditures and incomes. Corporate finance basically deals with the uh, day-to-day investing, borrowing, lending, budgeting, saving, forecasting activities of that is concerned with any corporate. And public or government finance means how the government finances carries out all these activities throughout the year, right? So this was all about the first pointer. Now the next pointer is the balance sheet. Now the balance sheet, also called the statement of financial position or statement of financial condition, shows that the company owns asset and what the company owns, which is also called assets, and how it is financed. The financial financing includes what it owes, liabilities, and shareholders investment equity. So balance sheet means basically it is a statement. Balance sheet is a statement where it shows the details of assets and how the particular assets are financed, the liabilities or the uh, debts that we have to pay off, and the shareholders investment, e- also called equity. And if you remember, the equation of balance sheet is total asset equals to total liability plus equity. Okay. Next is the income statement. Now, income statement also I have explained in my last video. It is also called profit or loss statement, profit or loss statement, or statement of operations. It identifies the profit or loss generated by the company throughout a financial year. Okay. So, income statement or profit and loss statement basically deals with all the activities that is carried out throughout the year, and its main purpose is to show the net profit or loss generated by the company throughout the year. Then we come to cash flow statement. Now, cash flow statement shows the cash received and spent during the period. Okay. So as the name sounds, cash flow statement basically is a accounting statement that deals with the cash and cash equivalents that is dealt by the company throughout the year. Then the fundamental relationship underlying the balance sheet, as I said, this is called accounting equation. Total asset equals to total liabilities plus shareholders equity. Then balance sheet typically classify assets as current and non-current asset. The difference between them is the length of time over which they are expected to be converted into cash, used up or sold. So as the statement self clarifies itself, that balance sheet classifies a particular asset into current or non-current asset. Okay, current asset is a short-term asset that will be soon that can be easily liquidated into converted into cash, and non-current assets like building, furniture, etc., which या फिर trade receivables, all the items that requires that will take some time to be encashed. Then current asset, which includes cash, inventories, unsold units of production. So inventory basically means stock, right? Stock in trade in accounting language. So current asset, which includes cash, accounts receivable, are, uh, are assets that are expected to be converted into cash, used up or sold within the current operating period, usually 1 year. So it further clarifies what I have said just now, that current asset are those assets which can be easily converted into cash and are expected to be converted into cash in the finance during the financial year. Non-current asset, sometimes called fixed or long-term asset, are longer in nature. Non-current asset include tangible assets such as land, building, machinery, equipment, intangible assets such as patents. These assets are used over a number of years to generate income for the company. The tangible assets are often grouped together on the balance sheet: company, plant, and equipment. The non-current asset may include for all financial assets such as shares or bonds issued by another company. So these are the details of non-current asset. As I said, non-current asset takes longer time to encash itself. The monetary value of an asset decreases over time due to use, wear and tear, or obsolescence. This decrease is measured as depreciation. Okay, so this depreciation concept also I explained to you earlier, that uh, depreciation is that value of an asset that is written off after an year due to normal year and tear. There are different methods of depreciation that also I have explained in the last video. Debt is money that has been borrowed and must be repaid at some future date. Therefore, debt is a liability, an obligation to which the company is liable. So, debt basically means udhari, right? And it is a liability for any company. Equity represents shareholders, owners' investment in the company. Mm, okay, so equity, as I this concept also I explained in the last video in details. Like equity is basically a method by which company raises fund, and in the those who have bought those equities are called equity shareholders. Debt can be split into current and non-current, short term and long term. Basically, current liabilities must be repaid in the next year, and including operating debt such as accounts payable, short term borrowing, the portion of long-term debt that is due within the reporting period. Unpaid operating expenses such as money due to workers but not yet paid are often shown together as accrued liabilities. Long-term debt is money borrowed from banks or other lenders that is to be repaid over periods greater than 1 year. Okay, so basically, debt can be classified as long-term debt and short-term debt. Long-term debt that is to be paid much later on, but short-term paid is that is required to be paid in the next accounting year itself. The income statement identifies the profit and loss generated by a company during a given time period, say 1 year. So this is the basically the what you call definition of income statement, profit and loss statement, that it identifies the profit and loss generated by a company during a given time, such as a year. In my last video, I have also, uh, you know, showed you an example of income statement. The statement of cash flow identifies the sources and uses of cash during a period and explains the change in company's cash balance reported on the balance sheet. So, cash flow statement deals with the changes in cash throughout a financial year. Now, this is important. This is why I have made another video for covering particular this thing. Okay, this is super important. Now let's uh, learn some of the important ratios. So what is current ratio? Current ratio means current assets by current liabilities. Quick ratio, current assets minus inventories by current liability. Inventories, why inventories is subtracted? See, why current ratio is used? Current ratio is used by the shareholders to ascertain the position of the company, okay, whether to invest in the company or not. Quick ratio means how liquid is the company. If the company goes bankrupt tomorrow, then how fast it will be able to pay the its obligations by encashing its assets. Inventories are subtracted because inventories sometimes uh, may contain such elements which cannot be encashed easily, right? So that is why quick ratio is in while calculating quick ratio, current assets minus inventories by current liabilities. Return on assets, net income by total assets. Okay, return on assets, net income by total assets. Basic earning power. Uh, uh, Operating income by total assets, return on equity, net income by equity, profit margin, net income by revenues, operating profit margin, operating income by revenues. Okay, so this was the all the important financial ratios. This return on equity is also known as PE ratio, and net income here you can see net income basically means profit. That means all the receipts minus expenditures is net income. Common stock, also known as common shares, ordinary shares, voting shares, is the type of equity security issued by the company. A common share represents ownership interest in a company. Common share have an infinite life. In other words, they are issued without maturity dates. So common stock basically means equity shares. Equity shares. Such shareholders have voting rights. They are entitled to dividends, but not they are not prioritized, right? These paying equity shareholders, their due dividends come after the company have paid dividends to preference shareholders, and also uh, unlimited liability. Okay, so if a company goes bankrupt, equity shareholders are not entitled to the any if the company is not undergoing profit, then the equity shareholders are not entitled to any kind of what you call a profit, any kind of profit or dividend. And most importantly, equity shares are the owners of a company. Owners. Company may also issue preferred stock, also known as preference shares. These shares are called preferred because owner of preferred stock will dividend before common shareholders. They also have a higher claim on the company's asset compared with the common shareholder if the company ceases operation. Okay, so as I said, these are the preferred stock are called preference shareholders, preference shares. Now, preference shares have few features like equity shares. First of all, that they are dividend paid before equity shareholders. Then they have not no voting rights. Preference shares do not have any voting rights and entitled to dividend even if company goes bankrupt. Even if company goes bankrupt. Then we common stock, that is equity share. Cash flow rights, right to dividend if declared by board of directors. Voting rights proportional to ownership. Preference stock, right to promised dividend if declared by the board of directors. The board does not have a legal obligation to declare dividends. Voting rights, none. Debt security, legal right to promised cash flows. Okay, so if the hierarchy, if I may say so, so the hierarchy of paying back the dividend is first obligation rises to debt, then preference, then equity. Okay, this is the priority of repaying debt, repaying the shareholders. Now, what is IPO? IPO, there is a long as definition here given. But if I, in simple words, I were to say, IPO means initial public offering. IPO is done by a company when it uh, decides to launch its shares first time in the primary market. If you recall, then the capital market is mainly divided into two categories: primary market and secondary market. And in primary market, new shares are dealt; secondary market, second-hand shares are dealt. So in IPO, primary markets are in IPOs are launched in primary markets. So the main difference between a private company and a publicly traded company is that shares of a private company are available only to select investors and not in trade in public market. A private company becomes a publicly traded company through IPO, which is the first time that it sells new shares to investors in the public market. Private companies become publicly traded companies for a number of reasons. First, it gives company more visibility, which makes it easier to raise fund capital, fund growth opportunities. It also helps attract talented staff, raise brand awareness, and gain credibility with trading. In addition, it provides greater liquidity for shareholders who want to sell their shares or buy additional shares. At or after the IPO, some of the original shareholders may choose to sell some of the shares. The fact that the shares now trade in a public market makes the share more liquid and thus easier to sell. तो इसमें तो मैंने जो बताया आईपीओ के बारे में वो ही बताया गया था और later on it has also mentioned why a particular see a company can either be a private limited or public company, publicly listed. Now, in case of private limited company, it is the shares are not publicly traded, right? That means ordinary people like you and me cannot have access to shares of private companies. But in case of publicly limited companies, we can also buy the share of the companies, right? Uh, because they are basically listed in the stock market, so anybody can access that. And further it states that why particularly a limited company goes public, or what are the advantages. So first of all, the advantage is more visibility. Okay. Mm, which makes it easier to acquire fund, attract talented stuff. Yeah, okay, let me list advantages of public. Wait a sec. Advantages of going public. First is visibility. Second is mm, growth. Third is credibility. Fourth is transparency. Fifth is hiring. Okay, so uh, all these advantages are all these advantages are linked directly with a company going from private to public. Stock split and stock dividend. Companies may on occasion conduct stock splits or issue stock dividends. Stock split is when a company replaces one existing common share with a specified number of common shares. A stock dividend is a dividend in which a company distributes additional shares to its common shareholders. Stock splits and stock dividends both increase the number of shares outstanding, but they do not change any single shareholder's proportion of ownership. When a company splits its stock or issue a stock dividend, the number of shares outstanding increases and additional shares are issued proportionally to existing shareholders based on their current ownership percentage. The overall value of the company should not change, so the price of each share should decrease, but the value of any single shareholder's total share should not change in value. See, stock split basically means I suppose I have 100 rupees, one stock of 100 rupees. I, as an individual, have one stock of 100 rupees of some company XYZ. Now, if the company decides to split its stock, then it might make this one share into 10 shares of 10 rupees each. So, okay, so that means now I will have 10 shares of the same company, and the value of each share will reduce or increase proportionately. Buy side versus sell side. Okay, so these are the stock market important concepts. Buy side refers to the firms that purchase securities and includes investment managers, pension funds, and hedge funds. Sell side refers to firms that issue, sell, or trade securities and includes investment banks, advisory firms, and corporations. So, buy side means basically those that side of the stock market. So there are two kinds of people in the stock market. First is buy side and second is sell side. Buy side means those who are engaged in buying that particular stock. See, the buy side refers to firms that purchase securities and includes investment managers, pension funds, and hedge funds. Sell side refers to firms that issue, sell, or trade securities. And sell side means the that party which is engaged in selling that particular security. What is mutual funds? Mutual funds means, as I explained in my earlier video, uh, uh, so many small investors pulling up their, pulling their funds together to invest into a common source of investment which has good returns, good amount of returns. Okay. For example, if I see an investment scheme that uh, let's say I have 10 rupees for investment and I go to stock market and see that in one type of stock, type A, accepts such small amount of investments, but then I have type B which gives huge returns. Let's say its return is, let's say, 60%, right? So in if I try to pull up some investors like me and aggregate our funds and decide to invest in type B, then what will happen? I will get more amount as compared to the investment type A, right? So this is called mutual fund. Still, let's read it out. A mutual fund is a company that pools money from many investors and invests the money in securities such as stocks, bonds, and short-term debt. The combined holding of the mutual fund is known as portfolio. Investors buy shares in mutual funds. Venture capital. This is also an important term. Venture capital is a form of private equity and a type of financing that investors provide to startup companies and small business that are believed to have long-term growth potential. Venture capital generally comes from well-off investors, investment banks, and any other financial institutions. So venture capital is a private type of investment that is done generally received by the startups which have good potential. Okay, good growth potential. Now, this concept is okay. So, venture capital means venture capital is capitalists are generally private entities. Okay, and that is why it is written here, private equity. Now, there is one similar concept called angel investor. So, angel investors are similar to venture capitalists, but the difference between these two is that An angel investor uses its own fund, and an angel investor generally comprises of HNI, called high net individuals. But in case of venture capitalists, it uses its own company's fund. They are generally companies, right? Venture capitalists, they are companies, but angel investors are generally individuals. But the concept of both of them is same, that both of them, venture capitalist and angel investor, invests in a new entity or new company or a new, let's say, a startup that has huge growth potential, right? Now we come to role of RBI. Now role of RBI is very shortly expressed here, but I have explained uh, the role of RBI in my last finance related video in a very detailed manner. So you are requested to, if anybody is watching this, you are requested to check that video out. So role of RBI, if I were to mention in very detailed manner, role of RBI has two kind of role. First is no, not two kind of actually. It has many kind of roles. First is printing money, printing and accounting या फिर recording money. So money, RBI has the authority to print money, and it also has the authority to keep a track record on the money that it has issued. Then it another role of RBI can be to check liquidity या फिर inflation. It takes necessary measures to control inflation in the economy. Maintain exchange rate. Okay, it also takes necessary measures to maintain sufficient exchange rate so that the value of rupee does not appreciate or depreciate against the dollar, which is global currency. Then another function of RBI can be mm, to, you know, last resort lender. So it acts as the lender of the last resort. If commercial banks have run out of cash, then it can resort to RBI for asking some money. And last is banker of banks. Okay, RBI does not provide services to normal people, like ordinary people like you and me. Rather, commercial banks are our banks, and RBI is the bank of the commercial banks. Okay, repo rate, as I mentioned in my last video, that repo rate basically means the rate at which RBI lends money to the commercial banks, and reverse repo means the rate at which commercial banks lend money to Reserve Bank. Now, bank is a financial institution that deals in money and its substitutes and provides other money-related services. Functions of Let me explain three functions of banks. First is providing credit, providing credit, specialized services like demand draft, online services, and then ATM services. Okay, a saving account. Saving account is a deposit account opted for by many who wish to save a certain part of their earning to gain interest in it. Uh, Current account. Current account is opened by businessmen who have higher number of regular transactions with the bank. It includes deposits, withdrawal, contra transaction. It is also known as demand deposit account. There is no interest offered in current account. Securities and Exchange Board of India, SEBI, is the governing body of the stock exchange board, right? It basically monitors all the activities that happens in the stock exchange market. Now let's go through some important data. That is, current GDP of India is $3.17 trillion. Repo rate is 6.25%. Governor of RBI is Shaktikant Das. Deputy Governor is MD Patra and MK Jain. Largest bank in the country is State Bank of India. Chairman of SBI is Dinesh Khara. Largest private sector bank is HDFC Bank, and CEO of HDFC Bank is Shashidhar Jagdishan. Okay, so these are some of the important data that we need to remember. And with this, I end my video here. I hope it was beneficial to you, whoever is watching this. If you think my video helped to you in one way or the other, then please do like, share, or subscribe because it motivates me to bring more valuable videos to you. Thank you.